Welcome and thank you for joining us. My name is David Widmar. I'm an agricultural economist with the Center for Commercial Ag at Purdue University. Today I'm joined with Dr. Chris Hurt, an extension professor in the Department of Agricultural Economics, and Dr. Michael Langemeyer, Associate Director for the Center for Commercial Agriculture. Today we're going to be talking about the 2016 crop outlook. This is in light of the latest data provided from the United States Department of Agriculture and yesterday's report. An outline of our presentation, today's presentation, we will summarize the latest results from that report, look at the crop budget conditions, consider the grain market outlook for the 2016 year and beyond, and finally we'll consider the economic settings that we're facing in 2016. Thank you, Chris and Michael, for joining us today. We're looking forward to the next hour or so conversation. If anyone has any questions as we go through today's webinar, I invite you to email me at dwidmar@purdue.edu. That should be along the bottom of your screen. We'll recycle that throughout today's webinar. I'll be checking my email and we'll respond to your questions throughout the webinar. And if we don't get them through the webinar today, we'll respond throughout the day by email. So thank you again for joining us. And with that, I think we're going to turn to Chris to start summarizing some of the USDA data. It was the markets responded. Corn markets were down quite a bit. Chris, what was in that report and what was going on behind the scenes there?
Well, two major reports. Obviously, the stocks report was one of those. We'll hit some highlights of that. But the really big market mover was in the acreage data. So we're going to look at that acreage report and give some evaluations of why the market had such a negative reaction, particularly on corn. So if we can look at the stocks first, really pretty neutral on the stocks situation overall, but let's start there with the corn numbers, and you'll see the pre-report expectations of about 7.8 billion bushels of corn still in inventory as of March the 1st. And that is very close to what the USDA did find. There was about 14 million bushels of lower stocks. Now again, when you're looking at a crop of 13 and 14 billion bushels, 14 million is very, very little. And with carryouts of 1.8 billion or so, that 14 million is just right exactly neutral. That was not would not have had any impact on its own in terms of the market price. Soybeans, on the other hand, were about 38 million bushel stocks inventory numbers lower than what the trade had expected. And when we have a carryout at 460 million, 38 million is at least a measurable amount, I think, lower. Now that's a touch friendly. My judgment would have been that that number by itself would have been probably 5 to 7 cents a bushel friendly to beans, friendly meaning bullish or upside. Now, of course, what happened is beans, immediately after the report, went down with the corn, did come back during the trading session yesterday. So I think that bullishness did get reflected a little bit, but certainly influenced by the corn later on. And again, the wheat was very close to neutral. Stocks levels very close to what the anticipation was. So the stocks report by itself, other than beans being a slight bit bullish, pretty neutral in those numbers. Now, what does that mean? It means that probably the size of the crop last year and the usage rate so far on corn and wheat is pretty close to what USDA has been suggesting. Now on soybeans, how do we get less inventory than expected? Well, there would be two ways to get that: higher usage. So maybe those exports are actually a little bit higher. Or maybe last year's crop was overestimated. They had too much estimate in last year's crop. So again, no, there won't be any changes, I don't think, from USDA at this point in last year's crop, but a little friendly on the beans from the stocks side. But the real news comes, of course, in the acreage we'll turn to now. And the big news was really at the top line, the corn acreage, and you can see on the right-hand side, the big surge in corn acreage to 93.6 million acres, up sharply 5.6 million acres from last year's crop. So clearly that was one important number, much more than anticipated, 6% rise. The other would be the wheat number. So winter wheat acreage we knew was going to be down pretty substantially, but we felt like maybe spring wheat acreage would not drop nearly as much, but that's not what farmers indicated to USDA. Wheat acreage down to 49.6 million acres. Again, a much bigger drop than was anticipated. Soybeans reasonably neutral, reasonably flat, a little bit less acreage than was expected going into the report on soybeans, but the big surprises were so much corn acreage. And when we looked at the wheat numbers being so low, a good bit of that came out of the wheat side of things. I think maybe just a glance back to 1996 on this chart overall. We go back to 96, that was the first year of freedom to farm, when we didn't have any set-asides in the United States, where acreage was really pretty much, we were back to full production. And we can see the really big decline in wheat acreage over this period of time. The overall increase in soybean acreage, left side of that chart, that pinkish line, 65 million acres. We've come a long way. That's China really driving that. And then on corn, the big surge from about 2006 to 2010-11, that was the big ethanol ramp up, and then with some adjustments after that. So these are dramatic. This year's changes, these are really dramatic numbers.
And it's interesting to look at. Corn is historically one of the third or fourth, it's projected to be one of the largest plantings in this data set.
That's right. In certainly modern times, this will be the third largest if producers follow through, which we're going to suggest they not follow through to plant this much corn. But that would be the third highest acreage in modern times.
And conversely with wheat, it's the record low, I guess, of this data set.
Yes, and I did not check how far back, but we're way, way back, 70, well, probably 100 years going back to get wheat acreage as low as under 50 million acres in the United States. So, this reflects a lot of the direction. A lot of countries produce wheat. There's lots of competition for wheat. We're not as competitive on wheat as some other countries. Some other countries have no other alternatives than wheat. We tend in much of our country to have some other alternatives we can go to. Okay, so here's the real changes in those numbers, and we start the third line down. That's wheat. If we go over to the box on the right-hand side on the third row down, 5 million less acres of wheat. So we were thinking 3 to 4 million. This was certainly a surprise to be down as much as 5 million acres. We knew the winter wheat was over 3 million acres down, but surprised to find the spring wheat that producers in the northern plains were not going to follow through and plant spring wheat. The second decline, major decline, is the fifth line down. That's sorghum acreage, down 1.2 million acres. So take the wheat acreage down 5.1, the sorghum acreage down 1.2, and that's 6.3 million acres, 6.3 million acres reduction in those two crops. Where did that go? Go to the top row, corn. Corn is king, and corn producers said, we like corn this year, and we're going to go heavy, heavy, heavy towards corn. 5.6 million acres. Again, the trade was expecting around 90 million. You can see the number under the 16 column there, 93.6 million acres, up 6%. Secondly, the fourth line down is cotton. Cotton up almost 1 million acres, 982,000 acres, 11%. And of course, this is really southern plains is where we're going to see that acreage. And we might also note that as we look down the fifth row, that's sorghum, but go below that, oats and barley also down. So lower feed grains, sorghum, oats, and barley, and we think that's primarily related to China. China had very high price supports on corn. They had high prices on corn internally in China, and that was causing some of their feed users to buy other products like sorghum, like oats, like barley, and distillers' dried grains from ethanol production. So they are changing that policy now. They're going to try to get their corn prices more moderate, and probably we won't see those substitutes for corn being shipped nearly as strongly to China. That means those grain prices were down, and of course producers have responded to that. These are really very large shifts, obviously, particularly to corn acreage. Soybeans, we might note, there was the second line there, down a little bit from last year, not a lot of change, 1%. We can look regionally at how these shifts occurred, and so the letters there on the left side, northeastern part of the United States, southeast, eastern corn belt, western corn belt, delta, northern plains, central plains, southern plains, west, and Pacific Northwest. All of them increased corn. Not only was corn good in the Midwest, it was good in the Southeast, it was good out on the plains, it was good every place. So really dramatic numbers. There's the 5.6 million down at the bottom of that column. Now let's look at, these are the three largest crops that we produce, corn, soybeans, and wheat. Look under the wheat column, and let's go particularly to the plains. NP for northern plains, 2 million acres less wheat in the northern plains. Where did that go? Of these three crops went to corn. 1 million of those acres went to corn. Central plains, now looking more Kansas, Colorado, that area. 1 million less wheat acres, all of it went to corn. Southern plains, 1.3 million less. So there's most of the wheat in the country, and obviously the center part of the country said we're getting out of wheat this year. In the southern plains went to corn, and not shown on this chart is cotton. So cotton, Texas in particular, picked up a lot of cotton acreage. So this kind of is the big story, and that is, if you look at the bottom of the column, 5 million, 5.1 million less acres of wheat, 5.6 million acres more corn. And David, let's go out those central plains, that sort of western Kansas, 1 million acres there that came out of wheat and went to corn. Does that make sense to you that that would go to corn in western Kansas?
We usually think about in the Corn Belt substituting between corn and soybeans. This is a corn versus soybean decision. And I think this year producers in the Central Plains had to think about, what am I going to plant other than wheat? And so the wheat budgets, from what we've seen from other land-grant universities, haven't been positive towards the wheat. And so it appears that they're looking towards adding that corn, that dry land corn, and maybe irrigated corn in some cases, to that rotation. So it doesn't surprise us completely, but it's not a dynamic that we see on a regular basis.
And the western half of Kansas has difficulty growing soybeans, and so I think for that particular part of the state, it's logical, if you're going to move away from wheat, you move into corn.
Okay, so yields. What kind of yields on dry land in western Kansas are we talking about on dry land corn?
I think it depends. You know, if we're looking at dry land, it's highly variable depending on how the year plays out. I think they can have some very respectable yields, maybe 100, 120, 130 bushel. But of course, if they hit any sort of weather hiccup, a lot of heat or a lot of a long dry period, it can really impact the yields.
So variability would be
Lots
pretty
of variability.
high, and certainly lower yield potential than kind of the Iowa, Illinois, Indiana kind of numbers.
For sure.
Now, you know, so a lot of that, if you look just at the plain states, we've got about 2.5 million more acres in the plain states of corn. But let's go to the eastern corn belt and the western corn belt. And kind of surprisingly, there's 1.5 million more acres of corn in the eastern and the western corn belt, and more beans, 840,000 acres more soybeans. So our first brush looking at this saying, wait a minute, USDA's overcounted acreage, or farmers have overreported acreage. You can't get more corn and more soybeans in the Midwest. But when we looked into this more, we found out, well, one of the problems last year was the prevented planted acreage. So if we can go to the next visual, this is just looking at those Midwestern states, and there was 2.8, almost 2.9 million over on the right-hand side, that tall bar, that acreage that did not get planted last year, prevented, reported to FSA as prevented from planting. So that was the two big states. Missouri, 1.7 million of those acres was in Missouri, and about 500,000 in Illinois. So when we go back and look at these numbers, and let's throw, if we will, if we can go to the next visual, let's throw Indiana and Ohio in there because those did have flooding acreage that didn't get planted, and those together add up to some pretty considerable acreage. So when we go back and look at this, what we think is going on is in the Midwest, the Missouri, Illinois, Indiana, Ohio prevented planted acreage is now, farmers are saying, well, we intended last year to plant it. We didn't get it planted. This year we will be planting that. So this is why we're getting in the Midwest higher corn and higher bean acreage, we believe at this point.
So to summarize, two drivers to the large corn crop. Substituting from wheat to corn
Right.
In the western states on
Yes.
the Central Plains, and then a return of the acres that were prevented planted last year into production, and they're leaning towards corn
That's
right now.
And in anticipation that we will get those prevented planted acres planted. Now, remember, every year there are some acres that do not get planted. And so that number may be across the country 2 to 3 million acres that normally don't get planted. Last year was 6.6 million didn't get planted, and it was focused that Missouri, Illinois, Indiana, Ohio area that got flooding in the early summer.
So that transitions us to the next question on everyone's mind is, as planters begin to think about headed to the field, especially in the Corn Belt, what will producers plant in 2016? Michael, looking at the budgets that Purdue puts out, do you have any insights? And as a reference point, the center website is www.ag.purdue.edu/commercial-ag, or you can Google us and it should pop up. And on our homepage, there's a link to our latest crop budget. So you've put those together and you've spent a lot of time looking at those. What can you share about planning decisions that producers should think about?
One of the things we've seen consistently the last few months, and actually for most of the last 2.5 to 3 years, is the budgets do favor soybeans. We saw that last year, and we've certainly seen it looking at the 2016 budget, which we initially put out in September, and we've been updating those on a monthly basis. This is our latest snapshot on contribution margin per acre for corn and soybeans on low, average, and high productivity soil. And so let's talk about these numbers a little bit. Before we do that, let's define the contribution margin. It's essentially market revenue from the crop, and we subtract out variable costs such as seed, fertilizer, repairs, chemicals, interest, insurance, these kinds of costs. And what's remaining cost that's not included or subtracted from market revenue to get the contribution margin is what I call overhead cost. This is machinery ownership cost, labor cost, both hired and operator labor, and cash rent. And so I've got the overhead listed there for low, average, and higher productivity. The difference between those three green bars is essentially cash rent. As you move from low to high productivity, the cash rent's quite a bit higher. But you'll notice here, let's start with the high productivity ground, that we're still going to have negative earnings. Our contribution margins are not large enough to cover all the overhead costs, but we're closer to being able to cover those on the high productivity ground. That's been very consistent the last few months. And so what that means is probably a little less pressure to reduce cash rent on the high productivity ground as there has been on the low productivity ground. So I did want to make that point. But also notice there, even on the high productivity ground, the contribution margin from soybeans is higher than the contribution margin for corn. That becomes even larger. That difference between the contribution margins becomes even larger as we move to average productivity ground and low productivity ground.
So in looking at this graph a little more detail, in blue and red we have the contribution margins for corn and soybeans.
Yes.
And because those bars for each soil condition is smaller than the green or overhead costs, that's a situation where we have negative economic earnings.
Yes.
It looks to me like your budget shows you would lose money regardless of what you plant.
Yeah.
But if you plant beans, you'll lose less money.
Yeah. Another way to put that is beans are contributing more to the overhead costs. It's not that unusual in production agriculture not to be able to cover the overhead costs. I mean, there's this year's we've got quite a bit of difference there. But if you take the period from 2000 to 2006, in several of those years, we did not cover overhead costs either. And so it's not that unusual to see that situation, but I think the situation in 2015, 2016 is the worst we've seen for quite a while. When you're talking negative earnings, 2015, 2016, they're pretty large negative earnings.
So what kind of insights can we have about the actual kind of break-even prices for corn production?
Again, the break-even price does vary by land productivity category. Let's focus on the high productivity ground here. If you look at corn price that we're using in the budget, we're currently using a corn price after basis adjustment of $3.60. Obviously, the break-even price to cover all costs is still above that, but we're getting closer to that $4 mark. And so we've taken off 25 cents from break-even in the last year, primarily due to lower fertilizer prices, but there's also been some help there from diesel fuel prices, and a little bit of help from cash rent. And so the combination of those things, we've taken about a quarter off of the break-even price on the high productivity ground. We still have a ways to go to get to that $3.60 price, but we're getting closer.
So improvements have been made.
Improvements have been made. Now, if you look at the break-even price to cover variable costs, that's extremely low. I do get some questions from reporters that ask me, why don't we just leave the ground idle? Well, that's a very important question, but as long as we're going to cover variable costs, which in this case for high productivity ground is $2, as long as corn price is above $2, we're going to plant something on that ground. And so we're going to plant something. Because we can cover a portion of these overhead costs. At least we get some return on the machinery investment we have, the amount of money we've got invested in land and our time.
So farmers can expect to cover their seed, their fertilizer,
Yes.
their fuel, and then the residual, the contribution margin, will be applied to the fixed costs and create some economic value for them.
Now, one of the things I did want to point out with this chart, and Chris, please add your thoughts on this, is it's going to be challenging on all land productivity soil in Indiana, but we have the biggest challenges on some of the lower quality ground. The difference between the corn price and the break even is much wider there, and so there really is a need on that ground to really look at our cost structure, look at everything we're doing with respect to seed, fertilizer, use of machinery, cash rent, look at all the cost items and try to figure out ways to reduce that break even. Because the pressure's on all of these land productivity categories to reduce costs, but it's really on the lower quality ground.
You know, we're probably going to be talking about corn in the mid-threes someplace as a price, and $4 cost on the very best of the land. You know, I think we don't want to overlook the average, and you've hit the low, but that average total cost looks like what, $4.25, $4.30,
$4.35,
$4.35. You know, we're still talking 75 cents to $1 below that.
Yes.
And of course, on that low quality soil, really a struggle here. So.
And the average, for example, Chris, we're talking losses of about $150 per acre.
Now, that's on average.
On the average. On the low, it's even more than that.
Right.
So how does this look? How do break-evens look for soybeans?
Let's look at soybeans here. Again, we've got the break-evens are higher than the soybean price, but again, the difference is not quite as big for the difference between soybean price and break-even. Break-even to cover total cost is not quite as large as it was for corn. But even on the high-quality ground, we're looking at a break-even right around 10, whereas our price here that I'm using in the budget is closer to $8.99. And so there's still quite a bit of difference there, $1.10, even on the high quality ground. You move to the low quality ground, and there you're looking at a difference. You're looking at a much larger difference. The difference is over $2 per bushel, and so just very, very large losses expected on the low productivity ground. But the losses are larger for corn than they are for soybeans. That's a consistent story that we're trying to communicate here. Is even though we've got losses for both corn and soybeans, the potential losses on soybeans are lower for every quality ground. I also looked at the Illinois budgets, and for most of the budgets that I looked at for Illinois, with the exception of high productivity ground in central Illinois, their budgets also show that soybeans are favored over corn.
Okay. Here in a second, we're going to look at how the rotations look, or the returns look over time. But for those of you just joining us, I want to make sure we all reintroduce everybody. This is Dr. Chris Hurt, Extension Professor at Purdue University. My name's David Widmar. I'm a researcher with the Center for Commercial Ag. And this is Dr. Michael Langemeier, Associate Director for the Center for Commercial Ag. Michael, how does this look compared to, how do the returns look compared to, from a historic standpoint?
Yeah, this is a chart showing the information, the budget, our budget information from 2007 to 2016. And what it shows here is a couple different things. It shows the drop in market revenue, but it also shows the drop in the contribution margin. Notice here that the variable costs have come down a little bit in 2016, but they really haven't come down near as much as they probably need to. And so this is showing that just that the resilience in terms of the costs. Particularly here we're focusing on the variable cost, but the same would be true of the fixed costs. As if you have a situation where market revenue is dropping rather rapidly and our cost structure is just not dropping as fast. And so that's why I was indicating earlier, there's a lot of pressure to look at the different cost items and see if there's some improvements that can be made.
So we expect these variable costs to continue to work their way lower, but it's just going to take
Yes.
several years to get there.
Yes, it's going to take several
And,
years.
I'd like to throw out, look at that contribution margin dropping from, this is on corn, $500 basically in the middle part of the graph to $200, but that's 14, 15, and 16. So we are really, 16's our third year
Yeah.
now that we're into this adjustment process. We look back to the 1980s, we talk around 5 to 6 years that adjustment process took. And I like to point out, we are in this. We
Yes.
are already moving through it. It's not like we've just hit the problems. That agriculture is really, this is our third year into the
Yeah.
adjustment.
And we're not showing it on this chart, Chris, but usually when we look at these budgets going out to 2018, 2019, it looks like 2018 and 2019 are closer to the break even.
Yeah.
So on the horizon, there are
Yes.
improvements still coming
Yes.
down into the future.
And maybe we're roughly halfway through that.
Yes.
Now we're not through the 16 crop yet, of course, but
Yeah.
we're at least 2 years into this.
And we're going to get into this later on, but it really depends on where corn lands long term.
What about cost?
When I
Does
say
it
when I
depend
say
on where costs
when I
are?
say we're getting closer to break even long term, that means that corn eventually is going to migrate towards 4. Because I think even on the average productivity ground, our break even is going to continue to drop until we get to about $4 break even. You can see that coming on in the next couple of years. But it just depends on where these markets do land, and we'll talk more about that later on.
So this is corn that we're looking at
Yeah.
now. What's it look like for soybeans?
Now, soybeans, you'll see a couple things here that are quite different. First of all, we never saw as high a peaks in the contribution margin for soybeans. As Chris was indicating on the previous chart, we saw some $500 contribution margins for soybeans. Looking back 3-4 years, they never quite got that high for soybeans, and so definitely there was a period of time. In fact, most of the period from 7 to 13, where corn had an advantage over soybeans with these budgets. That's been reversed here since 2014, and in particular here looking at 2016. So the contribution margin never got as high as it did for corn, but it didn't drop as far as it has for corn either. We're still looking at contribution margin for 15 and 16 right around $250 for average productivity soil, and so about $50 higher than what we
So
are seeing.
just
for
to make sure
corn.
I'm understanding correctly, the contribution margin that producers can get after they pay their seed, their fertilizer, their fuel, and start to look at paying their labor, their land, and their fixed
Machinery costs.
Machinery costs. For soybeans, that contribution margin is closer to $250 per
Yes.
acre. In Indiana, on corn, it's closer to 200.
Yes.
So this is part of the surprise that we
Yes.
saw when we looked at those reports
Right.
yesterday from the USDA.
Yeah, and I was just indicating, Illinois is not that different from what we're seeing here for Indiana, and I looked a little bit of Ohio State. Ohio State budgets also tend to show that soybeans are more favorable, and so it's a little bit. The report yesterday was a little bit surprising.
So if we kind of look at these returns, if you have a rotation that's half corn, half soybeans, how does that kind of blend together for?
Yeah, even though the soybeans look a little bit better than corn, the average is still not very pretty to take a look at here. And you're looking at negative earnings for 2016, at least from a budgeted standpoint, are just as bad, if not slightly worse, than 2015. Now, of course, through central Indiana, this is budgeted information. Through central Indiana, our corn yields were not very good, and so the actual negative earnings were larger than what we're showing on this chart, at least for central Indiana, where they had the very wet conditions last year. But just using our budgets, this adjustment period that we were talking about earlier, we've had 14, 15, and 16 are adjustment years. We're expecting another year or two before we get close to that break even, which on this chart would be a 0. I have that long-term line in there, that average line. That's the average earnings per acre, or economic profit, if you will, from 2007 to 2016. That's still pretty healthy, $50. And so hopefully people have been building up some reserves and have built up their working capital to withstand these more challenging years, 15, 16, and 17.
So one of the easiest ways, switching gears a little bit, one of the easiest ways we can improve this chart is if we have stronger prices, stronger grain prices. We didn't see that yesterday out of the report. Chris, can you kind of dive into the details behind what's going on with the price situation and what we might look for the next year?
Well, obviously on corn, the immediate market reaction was, oh my gosh, that's too many acres of corn. And so one of the messages the market told us yesterday, and one of the messages we are transmitting from the market, is that if you want to plant corn, the market says we're going to punish you for that with lower prices.
Economically punishing.
Economically punish you. So we're going to, the lower corn prices that we saw after the report is the job of the market. The job of the market is to send price signals to producers. And the reason USDA has this report at this time of the year is it comes out at the last moment, basically, that there could be some acreage shifted. And so that is the purpose of the report, is to get a measure of what farmers are thinking. If they're thinking too much corn, then the market price will adjust and try to give them incentive to plant less corn and to go over to some of these other crops. So we have, let's look first at the 15-16 column, the balance sheets that we look at. And just go to the bottom line, ending stocks pushing up to 1.8 billion bushels with a U.S. average price at $3.60 a bushel. Again, we're pretty far into this marketing year. It will end at the end of August, and so these numbers probably won't change substantially, but somewhat, but not substantially, from that 360 price. The 16-17 USDA number, the next to the last column on the right, those are just some projections that USDA did at the Outlook conference in late February. There are not a lot of statistical data to use there, and one of the pieces of statistical data they did not have was the planted acreage. So they were using more around the 90 million acre number. But you can see, looking down to the bottom of that column, the carry-out ending stocks pushing up to around 2 billion bushels, with an average price at $3.45, still going lower. Now, in the very last column, what we've done is to take yesterday's report and say, if you as producers, if you really do what you said you were going to do, and as reported by USDA, plant 93.6 million acres, that would give us a harvested acreage about 85.4. I'm using 167 bushels of yield. That would give us a production number on the second row of that column over to the right-hand side, about 14.3 billion bushels. Record size corn crop, never seen one that big. The 14 crop was 14.2 billion. Again, I've tried to increase feed usage a little bit more for ethanol, a little bit more than USDA has for exports, although we're going to struggle on exports. And that gets us up in the low 2 billion bushels, over 2 billion, 2.2 billion bushel carryout. I think that gives us a U.S. average price about $3.40, and maybe another way to rattle a little bit of getting some change in this corn acreage, some less corn acreage out there. Harvest time prices on down in the very low $3 range at harvest time. So those are a real struggle. Michael, you're talking on the best of the land, around $4
Yes.
a cost, and to have been talking about prices with average yields at harvest anyway, around $3 or low $3. That is a real wake-up call,
Yes,
I
it
think.
is.
And to clarify, this is kind of an average yield expectation. And so we've had several crop across the U.S. over the
That's
last
right.
few years that have been above average, and so an above average crop again this year would really push those ending stocks.
I think, Dave, that's a really important point. You know, a lot of us are thinking about the El Nino, La Nina. Will we have a shortened crop? We've had 2 good years in a row on yields in the U.S. Maybe we're ready for a shorter crop. There's the possibility that we go to above normal yields again for 3 years in a row, and then you push harvest prices below $3. These are really scary times to begin with, let alone to think about that side. So that's an interesting point. You know, I think a lot of producers are saying, well, eventually we're going to have that short crop and we're going to get these corn prices maybe back to $4.50 where we can cover all cost. So one of the things we thought we might do is let's look at those probabilities. So these are options-derived probabilities after the close of the market yesterday, after the big down on prices of corn. And what we're looking at is December corn. Now, December corn closed around $3.70 a bushel yesterday after the sharp down from the report information. And what we're looking at on the bottom or on the horizontal axis is what price level of December corn would we be looking at, from $2.50 to $5.50, and then the numbers on the curve are the probabilities that the price would be that high or higher. So let's start for maybe somebody that says, I've got a $4 production cost. What are the odds that the market is suggesting will be December corn $4 or higher? And actually the December corn price is pretty close to what we think the average Indiana corn price might be for the entire marketing year. So $4 corn, if you look at where $4 corn is down on the horizontal axis and go up to the line, 38% chance that December corn will be $4 or higher. Now that's under 50%. Why? Because corn yesterday was around $3.70. So where the market was yesterday, there's roughly a 50% chance it'll be higher than that and a 50% chance it would be lower than that. Now for those that are saying, no, I need $4.50 corn, and Michael, I think that's basically where you're getting to on average quality land.
That's closer to the average quality land break even.
And you can see what the market, options market yesterday was suggesting, only about 18-20% odds we would be at levels that maybe average quality land in Indiana could cover their cost of production, total cost of production this year. So there are probabilities. I had a student say they weren't going to sell any of their corn until it got to $5 a bushel again. So we ran these probabilities, and he helped run these probabilities. You can see about a 7% odds that futures markets would get up to give us something around $5 corn. So I think we come back to this, David, when producers say, well, you know, we're going to have that short crop year and we're going to have the weather that's going to bail us out, perhaps in terms of these prices. It's possible, and I think that's what this is saying. It's possible. Those probabilities that you get the extremely high 4s or 5, maybe 1 out of 10 chance, but that says the market's assessing 9 out of 10 that will not happen. So there's always hope, but I think making pure decisions in farm management based upon that 1 out of 10 hope would be short-sighted. And
I think looking at this chart, Chris, you also need to plan for a fairly high probability that corn could be below $3.50. If I'm reading this right, there's a 36% chance that corn could be below $3.50 or below. And so certainly when you're looking at cash flow planning for the fall, I think you need to be looking at a price that's $3.25 or something like that. It's kind of a worst case scenario at this time.
I think that's right. And again, I think what we'll see is probably some recovery from yesterday's sharp down in corn. We'll see some recovery because the recognition is the market sent a strong signal, plant less corn, and we'll get some adjustment. But still, I think this is an important point. Maybe there's a 1 out of 10 chance we look at $3 corn. There's a 1 out of 10 chance the market's saying you could be below $3 futures, $3 or lower, I should say, roughly 1 out of 10. So those tails are out there. They are possibilities, and the market's telling us that there's those possibilities. But I think we've got to be, if we're $3 or lower, obviously we're in survival mode
Yeah.
for a lot of farms. That's a scary 1 out of 10 chance.
So let's take a quick look at where corn future prices have been, and as we talked about where they might be going, let's take a quick look at where they've been recently.
This
Chris.
is July corn futures. Those of you that have old crop corn still pricing off of the May right now, but assuming we're holding off selling for a little bit here, not too long we'll be looking at the July, and that gets us on into the summertime. But let's start where that top red line kind of starts back in October. There's harvest time. And harvest time, July futures around 4 to 410, maybe as high as 420 a bushel. And the overall pattern since that time is down, 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 down. And we look back at this last roughly 6 months, 7 months now that we're getting into. And what we recognize is we should have sold every rally. You know, if we stored at harvest, prices went down, we get a little bit of rally, we should have sold it because the next sell-off goes lower and the next rally does not come back. Now that we had a lot of hope going through the winter time. We look at the bottom red line, January up until yesterday, that 360 level was the bottom. This gave a lot of hope to producers that we would not make new contract lows. And I can remember mouths dropping when we talked back in this winter about the possibility that we had not made the lows yet on old crop corn. Well, yesterday, that's what we saw, new contract lows. And so that's a very devastating statement being made in the market that the market is not low enough yet. Now, so today and the next several days will be important. Can we get back above that 360 level here on July corn? If the market can get back above that, I think it says this was an aberration. It was the report, but everybody knows we're not going to plant that much corn. Farmers won't do that. They'll back off of that. They will reduce corn acreage, and that'll get us back above the 360 mark. But this is a really scary moment for us. And again, as we've talked about, corn prices, cash prices moving to the lower $3 if we would plant this amount of corn. What's the best hope at this point? Sell every rally, I think, is the old crop. And that is, we see there on the July, that 375, 380 is what we're first looking at as the first opportunities on the upside, while we're nervously worried in the next few trading days that we can recover, get back above 360. We'll see kind of the same pattern on the next chart. Now this is the new crop corn. Again, 375, there's your bottom, there's your support. No need to get excited about selling corn, new crop corn. At 375, we'll get on up around the $4 mark most people were looking for until yesterday. And again, you see yesterday's price action on the very right-hand side, making new contract lows. That's really devastating to a marketplace when all those people like farmers that would like to see corn go higher, all the buyers, all the bulls in the marketplace, basically get it thrown in their face and saying, you're wrong, 375 isn't going to hold the bottom of this market. So I think you've got a really nervous market here on corn in the next few days. Hopefully we can recover back to that 375 and again get some opportunities in the $3.90 to $4 range to do some pricing. Now that may be weather. Some moderate weather scares, some delays in planting, that could pop us up to those levels. $3.90 to $4 on Dees corn. I think that's where we're looking at really starting a pricing program. We're going to be very hesitant to chase that market at this point. Hopefully we'll get some recovery in this market. Now to get above basically that $4 Dees corn, it's going to take some more severe weather kinds of situations. Dave, you're going to talk a little bit later about the demand side of the corn and the bean market out there. You know, I think that looks kind of weak. Probably going to be the supply that does that. So kind of summarizing, old crop corn prices, maybe not even to the bottom yet. This really makes us nervous. Be very careful about continuing to hold old crop corn. If you have a lot of inventory, remember we're going to have an abundant carryout, 1.8 billion bushels or so. And remember, what does that mean? It means that's corn that is not going to be sold and is going to be in storage going into next year's harvest. Somebody has to be given incentive to store that corn into September and October. Generally, you do that by depressing old crop prices enough so that there's a price incentive between low old crop and new crop for somebody like the commercial grain industry to store that corn. That's not a strong statement to say that you've got a lot of strength in old crop corn. There's a lot of corn has to come to market. Look for the basis to be very weak. There certainly seems like now weather disruptions are the only reason that we logically would get major rally potential. So what that says is we go back to our strategy the last 6 months. Every rally, we sell some more of that old crop corn. On the new crop corn, the third point there, the job of the market now is to say 93.6 million acres, farmers, that's too much. You gotta be discouraged. And the market certainly did its job yesterday pushing down those corn prices. That's the job of the market. And maybe for Michael and David and I, well, how low does that have to be? We think those incentives are strong now to shift to beans. But if farmers, why did they go so heavy to corn? Even when we had incentives on our budgets to go to soybeans. So does that have to be lower? I don't think so, but that would be this possibility. We have to get D's corn, not 370, but down in the 330 to 350 range. That's going to get sorted out here, I think, in the next couple of weeks. So we're going to expect some of that acreage to shift out of corn to beans and also to some spring wheat. Again, I think odds of major price recovery are relatively small. My student that said we're not going to sell any old crop till we get to $5, they've been on the wrong side of the market all winter, and I'd say they're on the wrong side right now. Major recovery, that looks small because we are going to have that 1.8 billion bushels or more of carryover. Right now, I'd say normal crop production, plan to store. We should have strong carry or strong premiums for storage in the 2016 crop. So start to line up storage if you're short on storage. And then another point we make really comes from this past year. Learn how to earn the carry in the market during the storage season, and certainly go back and review how to do that with a storage hedge. Now again, what we're looking at with the old crop this year, the 15 crop, is a storage hedge would have netted us on corn. We had about 410 to 420 July futures, July 16 futures last fall. We would have been locking in July futures at about, let's just use $4.10 a bushel, versus what happened this year. We let the July futures erode down to 30, 40 cents a bushel. So that storage return using storage hedges, go back, review your marketing, store, but consider storing with that grain hedged.
Okay, well, that's great advice. I think we're going to pull out our marketing materials.
Well,
and
that's
spend
a little
more
bit of
time.
looking over our shoulder. What should I have done
What should I
last
have
year?
done, yeah.
But again, here's the good learning opportunity. Last year I should have sold at harvest, but I want to earn the carry, the premiums that the market gives us for storing through the fall, winter, and into the early next summer.
Okay, great stuff. Let's transition a little bit to soybeans. Can we talk about, in our last 10 minutes or so, can we talk about what's going on in the soybean market?
Now let's just go to the right-hand column. We've got with reduced soybean acreage, again, following the report yesterday, beans going up. USDA has them at 850 in their early projection, 875 looking at the 15 crop. We've got them on up around $9 a bushel. Now again, I think that $9 a bushel comes down some as we actually see farmers read these price signals, go to more beans.
So we expect these to change as
these
producers
to change.
make their decisions.
Right
finally.
now, I'd say $9 is a good cash price on beans. If you can get that, there's a great place, old crop and new crop, to be selling beans. So let's look at the probabilities. Again, very similar to corn. Can we get, Michael's talking around $10 cost on the very best land. Again, 25% chance we'd have futures up around that $10 mark. Obviously, we're talking more down here in the $9 or low $9 range. But some odds, could we get down to $8 beans? Again, that's futures. 1 out of 10 chance that could occur as well. Beans have a little different pattern since last harvest, and that is more of a broad sideways band. This is the old crop or July beans that we're looking at on futures. Again, we're up there near the $9 cash, and that's what I'd say we're looking for selling at the high end of the range. Are we going to break out of that range and move on up to the $9.60 to $10? I think it takes a weather market to do that. So right now, selling at the high of the last 6 to 7 months is still the best strategy. On the new crop then, in the next visual, we got a little upward bias on this. And so again, I think we're looking at that $9.25, $9.30 prices that we're at right now. There's a starting point for us to sell beans, and I think getting 25 to 35% of our beans forward priced for new crop in the next month or two makes a lot of sense.
To summarize the soybeans a little bit?
Yeah, so the recent reports were actually bullish.
Right.
We were a little bullish on the stocks numbers, and secondly, the lower bean acreage should have been bullish. That got overwhelmed by the, oh my gosh, did you see how many acres in corn? And that at the Merck pulled down the beans yesterday, of which they mostly recovered yesterday as well. Old crop beans should be sold at the high end of that winter trading range. We just mentioned that. I think we will shift more acres over to beans, and that's going to moderate those $9 new crop prices a little bit. $8.75 or so is what we'd expect. Now, we want every producer, go back and look at your own budgets, for heaven's sakes. Our budgets, we think, show a lot of premium to beans, but look at your budgets and think about, can you make any of these adjustments still this year? Weather rally seems like kind of the last big hope for major price increase, and there's that recommendation on the new crop. Let's get 25 to 35% sold at this hopefully $9 cash or maybe a little bit higher, and generally our spring pricing window runs from about mid-March into mid-May.
Okay, so over the last few months through the winter, corn has trended lower, soybeans have trended steady
to a little higher, maybe.
A little higher, maybe. So I think this is a good piece of advice you shared, is for producers to go back, revisit their budgets, and make sure that make sure they're planning based on what makes the best economic sense for us. On our budgets that Purdue puts out, that Michael works on, it's suggesting soybeans. A little more return, still negative, but more return with the soybeans. Of course, economics are one way that we hope we can make the best economic decision, but oftentimes weather can also influence producers' planning decision as the weather window moves through the planting season. Can you talk a little bit about the planting season?
Just quickly, the updates yesterday afternoon on the 6 to 10 day forecast. On the left is temperature. Blue is below normal temperatures. Again, this is a week out forecast from where we are right now. Eastern Corn Belt, cool. On the right-hand side is the precipitation. Green is above normal. So a week out, we've got cool and wet in the Eastern Corn Belt. Western Corn Belt is warm on the left, the brown, and dry. So maybe the Western Corn Belt gets started a little earlier, but we look at the next week after that, the 10 to 14 day, stays cool in the Eastern Corn Belt, but we dry out. So this picks up about the 8th to the 15th of April. Looks like we may get really rolling as we get into that second week of April, and the Western Corn Belt will be planting and probably will get started. So right now, I don't think this is a negative forecast. It probably gets us started reasonably early. Then we went out and looked at kind of the spring, early summer. This is National Weather Service. The brown on the left is above normal temperatures. And for most of the Corn Belt, EC, equal chance. We can't call the precip above, below. Southern tier estates stay on the wet side. Could be some delays there in planting, but for the prime Midwest, looks pretty normal. We'll throw out one other point, and that is for all of the summer, generally for the continental United States, National Weather Service is going with above normal temperatures. Now, above normal temperatures would tend to lower corn yields if everything else were normal. At least some below normal.
Yes, okay. And another thing that people often think about when they think about above normal temperatures is drought.
Absolutely.
And so U.S. Drought Monitor is regularly updated. Here's a look at the U.S. Drought Monitor as of today. Of course, we're not into the corn and soybean growing season yet, but it's important to see where we're starting. So we see in the plains and in the Midwest, we see that there's a pocket of abnormally dry and moderately dry conditions there in the southwest parts of Kansas, an important growing region for the hard red winter wheat, also in the panhandles of Texas and Oklahoma. We also notice that there's a pocket of dryness in southern North Dakota and northern South Dakota that's been there. Of course, people who are hoping or talking about a short corn crop reference this, but when I was looking back a year ago, what we saw a year ago, I'll throw that up there now, that was there on the right. That was what the drought monitor looked like a year ago.
Wow, that's a lot different.
It's a lot different. If you're going to bet on a short crop for corn and soybeans, you would have probably preferred to have had last year's odds, but we do know that that ended up being a big crop.
And the dryness was where Indiana farmers wanted in the western corn belt.
Yeah. Right, of course.
And that
yes.
didn't pan out. Record yields out there.
Very strong yields. So that did not work out. Of course, one of the features to last year's growing season was the El Nino, which brought favorable rains to the Midwest. The question this year is, will the opposite, La Nina, occur?
And La Nina tends to bring more dryness to the
heat and dryness.
Right, if it comes in the
if
summer.
it comes during the growing season. And so the chart that we have showing you here it's a very busy chart, but it's an important one to look at. All the way to the left is showing you what the Pacific Ocean temperatures are that are used to monitor El Nino and La Nina. After January, they provide kind of an average, a 3-month moving average for those temperatures. Anything above that first dark black line, 0.5 degrees Celsius, those are El Nino conditions. Anything below the bottom dark line, or negative 0.5 degrees Celsius, indicates La Nina conditions. And so as you can see, most of those models, there's several models that are out there trying to forecast what El Nino, La Nina weather conditions that we'll be facing. Most of those, or all of those, have us trending towards cooler Pacific Ocean temperatures, which is a weakening El Nino.
And the timing is down at the bottom.
The timing
right?
is there at the bottom. So we see that in the April, May, June window, most of those weather models have us there transitioning out of El Nino and starting to go into that neutral pattern. So we see the neutral pattern starting to emerge in May, June, and July. A few of the models, however, have us dipping below that negative 0.5, that La Nina threshold, in June, July, and August. These are the folks that are talking about the chances of a significant drought in the Midwest in a short crop. It's important to note that the majority of the models, however, don't have us crossing below that threshold of La Nina until late in the fall, once the crop has already matured and we're rolling into harvest. In fact, the U.S. Climate Center predicts about a 50% chance of La Nina conditions rolling out into the fall. So it's going to be hard to bank or bet on a La Nina occurring during the prime growing season in the Midwest.
And probably the best percentage odds at this point are that if we do shift to La Nina, it will not come quickly enough to really have a big impact on Midwestern production. That's conventional wisdom at this point.
Conventional wisdom at this point,
with a lot of range and
and I think this is what this chart best shows, that there's a lot of possible outcomes out there on all these different models. And so there are a few models that say, yes, it can happen, but the majority of the models, the safe bet is that it's going to be coming late in the fall. Another kind of couple final pieces of information to keep in mind throughout the growing season in the summer months tend to trend towards the macro economy. On this graph, we have the U.S. dollar index. One of the big featured stories that we've been talking about since 2014 has been the rally of the U.S. dollar, the strengthening of the U.S. dollar. Of course, that makes it difficult. It makes the dollar relatively stronger, so it's a little more difficult for us to export our agricultural products globally. And we've seen those export numbers struggle to meet the targets and struggle. They've trended downward in the last couple months. Mid-January, about January 19th, is when that U.S. dollar peaked at above the index value of 95. Since January, we've seen the dollar come back towards that 90 range. looking forward, we don't expect this dollar to fall back to 2014 levels or mid-2014 levels, but it's important to note that the upward trend in the U.S. dollar has somewhat slowed down, and so that could provide some benefit to the trade and export in the trade and export area.
But we might also point out the boom years. Look back at 2010, 2008 first real boom. And when the dollar was low, this really stimulated U.S. exports and was part of the boom. And then again in 10, 11, and 12, it was part of the boom.
Yeah. That's very
and now
true.
it's part of the adjustment, the downward moderation.
Probably the silent actor here in the big boom. We talk about ethanol, we talk about exports in China. This has really been an important feature of that boom, and now it's playing into the recovery and the adjustment period as well. So we've seen some slowdown in the dollar's strengthening, so that's been viewed slightly favorably. Another note to make on the dollar is that we talk about the dollar broadly, and in this chart it shows trade-weighted exchange rates for specific ag commodities. What's important to note here is that the dollar strengthening hasn't impacted commodities in agriculture evenly. So we've seen exchange rate for the corn from 2012 to 2015, for example, appreciate 13%. When we get down, soybeans 3%, for example. When we get down to the meats in the livestock sector has been hit the hardest by the stronger dollar. So the trade partners that we're looking to for our meats and livestock have appreciated greater than what we look at for our soybeans or wheat markets, for example. Of course, last year was a big increase from 2014 to 15, was a big increase in the dollar strength as well.
This is looking at the importing countries, David, correct?
These are the countries that we're sending our products to.
If we looked at exchange rates relative to competitors, it would look quite different.
Quite different, yeah. So Brazil and the real has a very weak currency right now, and so when we look at what conditions look like there, they have weak currencies but very strong exports, and that's created pretty strong local prices for them. So,
And Michael, you look at competition. You look at incentives in Brazil to increase acreage with their weak value of their currency, selling in U.S. dollars in the world market. Are they like U.S. farmers with really narrow margins right now in Brazil?
Their soybeans have been quite profitable.
Profitable.
Even 12, 13, and 14 were quite profitable. It's even more so now.
And is that because they're more competitive and better farmers?
Not necessarily.
You better not say that.
No, of course not. But it does mean that the conditions are right.
And it's the exchange rate. It's
Yeah,
the pure
conditions are
exchange
right
rate impact.
down there
They're still making
to
money.
continue to expand the soybean acreage.
I think
That's a tough competition.
it's very important to note that while the U.S. producers are getting this signal of tight economic times, cut back on production, globally, we've seen producers in South America getting signals of prices equal to or stronger than what they were in local currencies at 2012 levels when they were record high prices here. Even to the north in Canada, the corn and wheat prices are much more favorable than they are given the exchange rate situation we have here. So keep an eye on the exchange rate. Keep in mind it varies by commodity, and it could be an important factor moving through the next year. Again, Chris Hurt mentioned earlier demand. How do we get out of this? Do we look to demand to grow us out of this? And unfortunately, the answer is probably not. We see that, again, when we looked at that boom area from 2005 up into 2008, 2009, we saw at the same time that we increased ethanol production, we also had a ratchet up of global economic activity. The most important one to look at there, I think, especially for soybeans, is China. The China economy was growing at 10% around 2005, and it jumped almost up to 15%. Huge growth in the Chinese consumption of ag products. Since then, we've seen China slowing down. Now they're approaching close to 5% economic growth, 6% economic growth. Some people say it could even fall even further. So when we think about what's going on in the broader global economy, it's difficult to look at demand as a solution for our current problems. In the long run, yes, demand, but it's very slow to increase in the short run here. So to wrap up and summarize today's webinar, the tight margin period continues. As Michael Langemeyer pointed out in the budgets, it's still important for producers to watch their cost of production, to know their cost of production, and to plan for ways to adjust their cost of production lower. in 2016 and beyond.
And also, David, I want to reiterate the importance when you're doing planning for this fall. Use several prices, because we're in a scenario we're looking at some scenarios, Chris, on prices that are really low compared to the possible output price. We have to plan. I mean, you have to plan for what you're going to do under these very large cash shortfalls. How are you going to come up with that difference?
This is a very good point, because Chris, I think your corn price range was $3.90 to $2.90, so a dollar swing there. That's a pretty big range of possibilities that we face today, and a lot of times producers drop in one value. Another key trend, a key summary to take away from today's webinar that Chris pointed out is that while ending stocks, where we stand today, look good, we have some concerns about the acres, especially the acres towards corn. So we anticipate that acres will adjust away from corn towards soybeans, especially here in the Midwest. But we encourage producers to carefully look at their budgets and think about how they're going to allocate their acres this year. And finally, one point from Chris's presentation today is that there are very strong grain inventories. And we look to be building those, especially if we hit those corn acres that the USDA forecasted yesterday. And so if we have an above average crop again this year, we could see those inventories climbing even more. And so it's very...
And it also says a moderate weather factor that is, rather small, that cuts back 500,000 bushels of production, or 500 million, 500 million, won't have a big impact.
Right.
Not a super impact on price.
There's a lot of...
We've got some cushion.
A lot of cushion in there, a lot of cushion in the market right now.
And the demand base you pointed out in the big world is just not robust right now.
Okay. Well, that wraps up our time with you today. We appreciate you joining us. Of course, this webinar will be archived and distributed through the Center for Commercial Ag's YouTube channel. Look for that to come up early next week. I'm David Widmar. Thank you, Dr. Hurt and Dr. Langemeyer, for joining me. And we look forward to you joining us for our next webinar. Thank you.